Hi everyone, welcome to my educational video series. Today's topic is advanced 529 planning. Lately, there has been some changes to this product. It is a product, and I thought I'd give you guys an update. And with this opportunity, I would dive deeper. If you have children, I know this is relevant to you. And if you don't have children, please feel free to share with your friends, relatives who might have children, and they might be looking into 529 plans. So what are they? If a 529 plan is designed specifically for college. Lately, it has been expanded for K through 12 education expenses, but long-term savings towards college, it works really well because of its tax purposes. A fair warning, because of its tax advantages, excuse me. A fair warning, because we are taxed at two levels, state and federal. Please check with your state rules. Today, I will cover federal rules, and as much as I can, California and Texas. What happens to your contributions from a tax point of view? It does not impact your taxes. No taxable income deduction is available at federal level. Same is true for California and Texas. The earnings, though, grow tax deferred, and they become tax free if you use it for its intended purposes, which is education. We'll cover more what the qualified distributions are. But before we get to that, an important distinction needs to be made between principal and earnings. The penalties and income tax that can be applied in the case of non-qualified distributions, they are applicable for your earnings, not principal. Both principal and earnings can be withdrawn tax-free, as I mentioned, at federal and in most states, if they are qualified, if they're used for education purposes. If they're not qualified, if they're not used for education purposes, then a 10% penalty and the income tax is due on your earnings, and in most states this is true. California 2.5%, Texas is same 10%. Now, if you are in a state where you deducted your contribution from your taxable income, then most likely a recapture is applicable. How do you compute when you take money out of a 529 plan? How much of that is principal and how much of that is earnings? The answer is pro rata. Let me give you an example. If you, let's say, put 80,000 in a 529 plan and it grows to 100,000, that 20,000 growth is 25%. So once you start distributing, 25% of every dollar will be considered earnings, 75% will be principal. Now, if the beneficiary dies, receives a tax-free scholarship, this is an area where parents ask a lot of questions. What if my child receives scholarship? Well, then the distribution, even though you may not use it for education purposes, the penalty is waived. Same is true for employer assistance and military academy. If your child attends the military academy, in these cases, these are supposedly non-qualified distributions, but the 10% penalty is waived. Unfortunately, income tax is still due. What is a qualified? What is a non-qualified distribution? Anything related to education, tuition fees, books, materials, computers, software, most things you purchase at a campus. Room and board is included as qualified. Principal and interest, this is new, of student loan payments of up to 10,000 per lifetime is included as qualified. Now, K through 12, this is tricky. I have some clients excited about this. Yes, 10,000 a year per child. You can use 529 plans, but this is not recognized by California. So Federal level, yeah, you will be able to use it, but California does apply penalties and income taxes on the earnings as they are not qualified. Texas does recognize this rule. Student loan payment is also recognized both by California and Texas. Anything outside of this is non-qualified, and non-qualified includes travel back and forth, health insurance, even though it's provided by the college, and extracurricular activities. Who are the parties to a 529 plan? There's an owner and a beneficiary. Owner, typically a parent, one of the parents. Beneficiary, typically a child. Owner has full control, maintains all relevant controls, investment choices, how much money goes in, how much money goes out, when. Beneficiary has no control. The beneficiary has to be a U.S. individual. Beneficiaries can be changed. Well, even owners can be changed by the owner. But it has to be an eligible family member. This is such a wide net. You'll have a hard time not finding a eligible family member, because it includes not only the children, other children, their spouses, immediate family, brother, sister, mother, father, and their spouses, nephew, niece, aunt, uncle, their spouses, first cousin. So it's such a wide net. Now, if you change the beneficiary one or more generation lower than the original beneficiary, then it becomes a taxable gift. Trusts can own a plan, and if the owner changes the ownership to a plan, to a living trust, it's not a taxable event. How much can be put? There's a lot of confusion in this area. There's no annual limit up to the maximum account balance, which is most cases $500,000. In California, 529,000. It's easy to remember. 529 plan, 529,000. So you can put up to that amount in any given year per child. I know it's not realistic, but I just want to change the paradigm from annual limits. There's practically no annual limit up to that. But if you go above gift tax limits, which is $17,000 per person, per child, per year, then gift taxes are applicable. Let's give an example. Husband, wife has one child. Each parent has $17,000, so $34,000 per child per year can be put in a 529 without gift taxes. If there are two children, then multiply by 2, 68,000 in this case. If you go above that, you either choose to pay gift taxes, which I don't think there's any need because of the following. You can apply the balance, anything about 17,000 per child, per parent, per year, towards your lifetime estate tax exemption, which is currently at $12.92 million per person. For a couple, it's $26 million. So unless your estate is worth north of $26 million, you can apply any gift towards this balance and not pay gift taxes. A quick example, let's say in a year you put $134,000 in a child's 529 plan. Your husband, wife, $34,000 is gift tax free. You have $100,000 extra. You can apply that towards this balance, which goes down to $12.82 million for one of the individuals. So it becomes, instead of 26 million, 25.9 million. So crazy amount. So that's why I tell my clients, don't worry about gift taxes. You have plenty of room, again, unless your net worth is over 26 mil. The other thing you can do, let's say you're running behind, your child is 12, 13, and you have 5-6 years. You can apply sweeper funding rule, which means you can contribute 5 times gift limit, which is $85,000 per parent per child, and still not pay gift taxes. But in that case, you cannot contribute in the following 5 years, and every year in that next 5 years, year 2, year 3, year 4, you have to file taxes to show that you have taken advantage of that, and that's why you shouldn't be paying gift taxes. How do you invest in a 529 plan? Typically, mutual fund used by offered by the plan provider. You can only make 2 changes a year for the existing funds. Rebalancing doesn't count. So when you make a contribution, they are automatically distributed towards the existing allocation. This rebalancing doesn't count. But if you want to change the allocation, you have 2 chances a year. Unlimited changes for future contributions. You can keep changing. Oh, for next year's, we should do this or that. That's not included in that 2 times a year rule. Last slide, excuse me. Secure Act 2.0 made it available effective next year to change a 529 plan to a Roth. And there are caveats to this. When I first heard about it, I was really excited. And then when I look at the limitations, it's like, oh, okay. But if the beneficiary of a 529 plan, let's say your child, and the owner of the Roth, same child, is the same person, they can transfer without penalties their 529 balance to a Roth. The good news is income limitation does not apply. Usually, per person, 138,000 is the amount your Roth contribution starts phasing out. At 153,000 income, you cannot make a contribution to your Roth. But in this case, it does not apply, so that's good news. You must have earned income, though. The account must be open for 15 years. So if you opened an account thinking, okay, hey, let's take advantage of this, the child is 17, well, they have to wait until 32. And funds must be there for 5 years. So not much creative thinking they allowed. Annual contribution limits apply. This is contribution limits to the Roth, which is currently $6,500 for ages 50 and below 50 and above 7,500. So if your child is 22, $6,500 annual limit to a Roth applies. And lifetime max is 35,000. So I think practically what's going to happen is people will have some extra in their 529 plans for one reason or another. And now they will have 2, 3, 4, 5, 6 years of Roth contributions available to their children. So they won't have to worry about it while they work and save for other things. This is it. If you have any questions, you know how to get a hold of me. And thanks for watching my video. All the best.